Hello everybody and welcome back to the Cyclical Investors Club. We had a request for L3Harris Technology's analysis, so that's what I'm going to do in this video. As always, not investment advice. This is just what I think about the stock at the current time. I am long this stock and we've owned it for about 2 years now, and it's pretty much flat. I think it's down about 5% today when I looked at it. It hasn't been flat the whole time. It's gone up and then come back down. And after I started looking at it, it's a really interesting one to take a look at because it gets a little, there's just a lot of little things to consider, especially when it comes to M&A. So the first thing I check when I just open any stock chart on Fast Graphs is I look to see what the historical earnings cyclicality is. And if we look at the fast graph, we see this dark green shaded area is the earnings per share. And what I'm looking for are drawdowns in the earnings per share growth. So I don't see any like right away. It looks like there might be one right here in 2013. So let's shorten this fast graph real quick and take a look. Actually, let's shorten it up to about there and to there. Okay, I think we got them all in here. So we have a earnings growth decline here of 6%, one in 2017 of 3%, 22 is flat, and then this year's expected to be down 5%. So what I really want to know is whether earnings are really deeply cyclical, kind of moderately cyclical, or secular growth where they've just never gone down. This is very low cyclicality. Just these single digit drops, like more than 50%, I would consider a deep cyclical. If that's the case, I use a different style of analysis that doesn't rely on earnings. Because when earnings fluctuate a lot, it can send the wrong message about the valuation. Usually they are the opposite often. So if it's a cyclical business, the earnings might be like earnings per share, PE ratio might be single digits during the peak, and then earnings will fall off a cliff, and then when they start to recover, earnings PE will be like 100 or something, and that's actually when you want to buy it. So if I determine that it's really deep cyclical, I use a different style of analysis, but that's not the case here. It's fine to use earnings. We'll just take into account that sometimes earnings are kind of flattish or decline a little bit. So after I decide it's okay, then I need to choose a time frame to look at. Kind of the standard one I've been using lately is 2015. Ideally, I would want like a full normal business cycle, but we haven't had a full normal business cycle since 2007 probably. So a lot of businesses have changed a lot since then, and a lot of different things have changed. So usually I start with 2015, and then in the back of my mind, I have a way to kind of, later on I'll show, to kind of control for recessions. Because there's not a real I don't really count the 2020 recession as a recession. For some businesses it was horrible, and for others it was great, and for some it didn't matter, and then we had the stimulus and everything. So 2015 is kind of usually where I start, and that's what I use for this company. Now, there isn't anything that like really jumps out at me here just from looking at the fast graph. So the next thing I would do is I want to determine basically two things. I want to determine the earnings growth rate, adjusting for any share buybacks, also adjusting for any years where earnings drew down. And that would include 2017 in this time frame, and also I will use forward earnings here. Which fell as well. And then the current earnings yield that the stock is trading at based on these forward earnings here. And so with those two things, I will extrapolate those earnings out for 10 years. I will determine, if you owned the business, how much money you could collect from it over that time period, and what kind of compound annual growth rate that would translate to. So that's the process that I use for these. But there are, and in some ways it's really simple, but you always have to make all these little adjustments and little judgments along the way, and that can usually be the difference between making a mistake or paying too much or not realizing a danger or something like that. So, and that is actually the case here as well. So the first thing I would do is look at the shares outstanding to see if they've been buying back a lot of stock, so I can adjust for that. And over this period, we see that they had these two big spikes in shares outstanding. So whenever increases, so whenever I see that, I know there's probably M&A that's happening. Typically, if there's M&A that's happening, my old rule was wait 3 or 4 years afterwards to let all the enthusiasm of the M&A work out, the initial costs work out, all the promises that they make that were wrong, we'll call it, to be priced back into the stock, and then to look at it. In this case, this was big M&A here, but it was a merger of equals, and it was an all stock deal, which I'm not quite as strict about, I guess, in terms of like avoiding them, and which is why I did end up buying them. But in terms of adjusting for the shares outstanding, I mean, the shares outstanding have grown, so there's not really an adjustment to be made over this long period, because the earnings are on a per share basis, so they will automatically be adjusted for increases. But from here to here, we see that they have been buying back shares the past 3 years. And so when I just cut it down to like the end of 19 through today, like the last 4 years, they bought back about 14% of the shares. I will try to adjust a little bit for that when I estimate my earnings growth rate. So I adjust for that. Let's take a look at, and sometimes this makes a big difference. I don't know if it will this time. FastGraphs also does a quick earnings growth rate estimate here. So they measure from this point to either this point here, or I don't think they use forward earnings up here, which I do. So that's one difference, but they also don't take into account this down year here or the shares outstanding decreases. So those are the adjustments I make. Sometimes it makes a big difference in the earnings growth rate, depending on the time frame and how much shares a company is buying back. But for here, FastGraphs is estimating 9.78% earnings growth over this time period. And let's see what I have. I don't remember what it was. So mine is slightly more conservative here. This is the spreadsheet that we use in the Cyclical Investors Club. I just kind of isolated LHX here, but we track over 550 stocks, and they update in real time here. At least the price updates in real time. So the earnings growth rate is what we're trying to figure out here, and mine is a little bit more conservative than FastGraphs because of those share buybacks, because of that one down year, and because I'm using forward earnings. So that all kind of makes sense. Like that's about the difference, 1% difference or whatever. The other thing I like to check is the revenue growth. Now, what these guys have had M&A, so the revenue growth is usually going to be inflated and not very. A lot of times, what happens is a company has revenue growth, it slows down or goes flat or goes negative, and so in order to hide that or cover it or try to remedy it, however you want to frame it, then they'll like have M&A and they'll go buy something, and you can't really tell, because then they combine the revenues together, and now you can't really tell what revenues are doing. Revenues are a big tell a lot of times if it's not a cyclical business, what direction they might be heading. Especially I like to take like 3 years worth, which is what I do here. So revenue grew 17% for them over these 3 years. But you can see that probably after next quarter, it's going to be probably flat. Because it did trend it down, but now it's on trending back up again. So for me, that doesn't really tell us a whole lot either way, but it is something that I check, and I would just say I will be like kind of neutral on this right now. If we got to a situation where next year this revenue topped out and started trending down, and we were looking back here and things are looking like they're trending down over that from like 2021 through 2024, I might sell the stock based on that. So it's definitely something I would keep an eye on, but not anything I would act on right now. So let's see what the best thing to look at next is. So we have the revenue growth, which is about almost like 8.71%. So the next thing we want to figure out is the earnings yield. And this is where things are going to get a little interesting. So this is what analysts are expecting for adjusted earnings per share for 2023. I haven't looked, but we're probably 2 quarters into this, right? So they probably still have 2 quarters to report before this year's end. So the closer we get to the end of the year, the more accurate this number usually is. So it's probably pretty close to what will actually happen. And if that's what they end up earning this year, then their PE ratio will, well, I think I adjusted this one already, so we can't, well, maybe I'll look in fast graphs real quick. I made an adjustment already to that one. So the blended PE here is 14, so that's about, we'll just see what it normally would have been before I made adjustments, which is earnings yield of 7%, right? So there are 2 adjustments that I'm going to make to this one. One of them is kind of standard that I'm doing for everything right now. It's for debt. So if we look at that, and the way I do this is I take the total enterprise value, which includes all their debt and other obligations sometimes, and then the market cap, and I just look at how much a percentage higher the total enterprise value is compared to the market cap. And then I add that or multiply it as a multiplier into the stock price so that it includes us paying for that extra debt. Like if we were the owner of the business and we wanted to buy it, we would pay the market cap, and then part of that would be taken up by the obligations as well. So the reason I do that, I didn't used to do this, but with interest rates having risen, the debt is going to matter over time, and it could be a drag on earnings, where it more so than it hasn't in the past. So in practice, what would happen is that 8% or 9% earnings growth rate, because they have to pay more for their debt, might go down to like 5% or 4%. So this is it's a quick way that I can track and kind of control for it in general. So, and I think that, which I've already done in the spreadsheet. So the debt adjustments here. So I adjust the price of this stock by 28%. 1.28 is 28%. Higher. So that's the real stock price. This is the debt adjusted price. Okay, which means it would have to fall lower for me to buy it. Okay, is ultimately this is just a way I can do it in the spreadsheet where it all kind of works fast because I track a lot of stocks. So that's one adjustment that would make my valuation more conservative. A lot of times when I use this adjustment, the business owner's CAGR, right? It usually, which is what I use to compare to other stocks or bonds or whatever over 10 years. Usually that gets much closer to the market average once I take debt into account. And cash on the other end. If a company has a bunch of cash, usually that makes their valuation look more reasonable. And then if a company has a lot of debt, usually it looks their valuation that might look super attractive might look less attractive, which should totally make sense. Like that's how it's supposed to work. So we have that adjustment, and then I think when this came in, when I had that adjustment, the business CAGR was it was almost 7%. So here it's almost 6%. But I made one more adjustment because what I noticed, whenever you have a company that has like a lot of M&A, which these guys do, they're also buying Rocket Jet or Aerodyne, or I forget the name of it. I think it's both of them combined together. There's been a lot of M&A in the in the defense space, but so they even have more coming on. So when things look a little too good to be true, or just a little more attractive than the rest of the market, it's usually a good idea to try to figure out why that, like what's the reasoning for it, and maybe there's a rationale behind it. And so if you have fast graphs and you ever run into that situation, especially, it's almost always when there's M&A involved, because these are adjusted earnings. So this is what management's kind of telling you, what they think earnings are. But if you go to the basic earnings, it will sometimes give you a much cleaner, unadjusted number. And a lot of times what you can do is, if you look at the stock price, like before, you look at it and it's like, oh man, the market seems irrational, But when you look at here, okay, when these basic earnings rose, the stock price rose. When they started going down, you see this little spike here, right? I think this is around the time they had the M&A, so maybe they got some excitement behind that. COVID's here. We have rising earnings. The stock prices are rising along with it. And then right when this drop comes, the stock price comes down. And then these are just expected earnings that haven't actually happened yet. So we're really somewhere right here in this process, and that all kind of makes sense. Especially when you take into account that debt probably didn't matter too much until about right here, which probably helped fuel that extra little leg down. So when I have that happen and there's a big disconnect, I take the basic earnings, and that's what I've done instead of the adjusted earning, which is a big difference. It was like $12 for the adjusted earnings this year, and the basic earnings are expected to be $8.23. So what I have a little column here that I use every now and then in my spreadsheet for basic earnings. I don't use it very much, but when I was looking over this, I noticed, I didn't even have it adjusted yet, but when I took another look, it made sense to me. So when you look at the basic earnings that are $8.20 now, and you adjust it for the debt, now the PE ratio is more like 21. Okay, so now it doesn't look so cheap, right? Before, let's see what the fast graphs, I forgot what it was. That's on the basic. On the adjusted earnings, the PE ratio was 14. So that's a huge difference. And it really does explain, so right now the average market 10-year CAGR, which I'll explain in a second, I haven't done that yet. It's about 5.5% or so, right? So when you look at theirs, it's just a little bit better than that. It's pretty similar to what the rest of the market is. So now it doesn't look like cheap, and that's probably makes the most sense. So the way I determine this, and I write this in all my articles if you read any of them, I basically view it from the point of view of an owner of the business and how much earnings you could collect over 10 years, and then I just convert that. And if you join the Cyclical Investors Club, you can dig into this spreadsheet here. But I have it all, it's all kind of laid out right here. So here's how if you invested $100, here's how it would grow, right? You take the earnings yield, which was like 4%, I think. 4.81%, and then I usually give the first year of growth, so I would add like that 8.71% growth the first year, just to kind of prime everything here. And so if you invested $100 into that business, you could take $5.23 out, and you get paid that, and go buy a cup of coffee or something, and then the next year that would grow. And you would have it, this is the total amount you would take out. So the next year it would grow, you get another $5 and something, a little bit more because it grew. The $5 grows, the $100 does not grow. Just the $5, that's what's getting kicked out by the company to you. So you go through this process for 10 years. And if we go, I think I have it showing what it is each year. Yeah, if you go farther in the spreadsheet. So yeah, so first year it pays you that, second year, third year, fourth year. and then collect it. If you collect all this, that's what the other area I was showing you was. So if you collect all that on top of your $100 for 10 years, you end up with $178. And if you put that in a CAGR calculator, that's where that 597 comes from. Okay. So it assumes that money's not reinvested. It just assumes, and it's a pretty good way to get a pretty good valuation estimate, especially at the extremes when it gets really high and really low, and there's not really a great reason for it, or there is a great reason at the time, but it's not probably won't last a long time. So that's what we get. Now, the range I created to tell whether a stock is like a buy, a sell, or a hold. If it's under 5% here, that would be where I would look to sell. Like either the earnings are falling or not growing fast enough compared to the price, or the price has gotten so high that the future returns of the stock probably are going to be less than 5%. And so that's about when I would look to sell, And then if it's 8% or above, that's pretty good. I mean, that's better than the market, and it doesn't mean your return's necessarily going to be 8%, because in real life there is like mean reversion. The market does kind of change its mind. So, but for valuation purposes, about 8% is where I would look to buy. So if you take that into consideration, if you just use the earnings, which is what I'm doing here, and the earnings growth, the basic earnings, it would become a buy if it fell to about 115. It's right now it's at 170, so it needs to fall about 32%. Now, I have another method because certain stocks can fluctuate a lot. Obviously they can fluctuate a lot, but certain earnings of certain companies can fluctuate a lot. The more cyclical ones, or moderately during recessions, or during when something bad happens. If you look at like a chart of Target or something, you can see it, or Dollar General is another one. Earnings can fall a lot kind of temporarily, and the market can kind of freak out, and it would throw this number and make it pretty negative, like it would make it look kind of bad, worse than it is. So I have a factor called recession PE factor. I'm not going to get into great detail about it here. We don't really need to on LHX because it doesn't have earnings that fluctuate a whole lot, and that's why these are very close together. But what it does tell me is that when I look at previous recessions, that the buy price here and the buy price I'm getting over here, once I made all those adjustments, are about the same. And that tells me, and it's at a time when earnings fell about what they probably would during a bad year for them. So that tells me my adjustments are probably on target. Like, that's kind of a confirming factor. So I think if you bought around here, assuming the earnings don't change drastically, something bad doesn't happen, you would have a good probability of getting really good returns over the next 2 to 5 years or so, depending on how long things take to recover and all that kind of stuff. But you should be able to get decent returns if you wait and buy there. So there aren't too many people that are going to come out and tell you not to buy the stocks that they own. But I think the main thing I didn't take into account, I mean, the fundamentals looked better when I bought it 2 years ago, for sure, because you've seen there's been 2 years where earnings basically went nowhere. And I think when I bought it that year, they were rising pretty quickly. I mean, we can look at it actually. So, yeah, so I bought it in 2021 here. So that had this wonderful trend going on, and then it just was like flat down, but the main thing was I probably should have used basic earnings at the time, and I did not. I used the adjusted earnings. I didn't notice a reason for it yet. And they looked pretty good too, right here. But it was they were definitely lumpier, I probably would have had a slower earnings growth rate and maybe should have been a little bit more picky about the M&A. I kind of made an exception to my rule. But so yeah, I wouldn't buy it at today's price. I would wait and see if you can get that 30% decline. And at that point, you probably do pretty good if you buy it down there. Okay, thanks for watching. I should have my Patreon account set up now. I'll take, for the normal channel here, I'll do S&P 500 stocks if you request them. I'll do a analysis. They might not all be, they probably won't all be this long. I mean, usually I can tell in like 30 seconds the reason why I wouldn't buy something. Sometimes I don't have the data. Sometimes it's just not a good fit for like my strategies, and sometimes I don't have anything I can really figure out about it. So in that case, they'll be like much shorter. So you can request any of those stocks in the comment section that are in the S&P 500, and then over on Patreon, assuming I get everything set up right. Even if a stock isn't in the S&P 500, I will do an analysis there, and then those members will get a big discount on my private service, my Cyclical Investors Club service, which has the spreadsheet and everything that you saw, chat, everything. You just message me. Usually I get back right away, all kinds of stuff. So yeah, subscribe if you haven't subscribed. There's going to be a lot more videos coming. Request the analysis that you want to see. It might be 30 seconds long, or it might be 15 minutes. We'll see. And have a great day.